Do you have some extra cash you want to throw into the stock market? Here are my top 3 recommendations. Starting off is a fairly new one called SPYT, which tracks SPY, which is the total market, or the S&P 500, which is a collection of the top 500 companies around the world. If we go over and look at the About tab for this stock, it says that SPYT is an actively managed fund of fund seeking to provide current income through option premiums on daily call credit spreads on the S&P 500. So all that means is the founders are doing call credit spread contracts, option contracts on S&P 500s in a bullish manner, saying that the stock market will increase. The only downside of this is that if the S&P 500 decreases, then this stock is also going to decrease. However, this stock has mainly been sticking around the $20 mark. It's opened up first in March 7th, 2024, and as you can see, it is not very volatile whatsoever because this is strictly for income. You're supposed to put a bunch of money in there and then each month receive those dividends or reinvest those dividends to further increase that dividend payout. As you can see right here, I have about $300 in there, not a large amount, about 15 shares, and I am going to be paid out $5 for this month. And this one I kind of just have sitting there and reinvesting. Eventually I'm going to start putting more money in and maybe do every month throw a few more hundred in there just to further increase the price. One important thing to note, so I have $300 in there and I'm receiving $5 in dividends. If you do the math right there, that's only 16% if it stays consistent throughout the year. So the founder's whole target goal is 20%. However, it's not guaranteed that it's going to hit that. It strictly depends on how well the SPY is performing and how well the total market is performing. If we're looking at the past price history between SPY and SPYT, you can see that they're fairly similar, with SPYT being on the left side and SPY being on the right. They pretty similarly match each other, except because of the share price. SPYT might have a little bit more increase or a little bit less increase. But as you can see, overall, SPYT follows SPY. So the one big worry I have about this stock is that if you take a look at the S&P 500, it's pretty much at an all-time high, which isn't always the best time to buy because there's a great chance that there could be a dip in the market, and without there being a nice support level, it's hard to say where the stock is a comfortable share price. So that's one important thing to note. If you buy in at 550, it's no guarantee it's going to stay there. You know, there's been speculations about a recession or a market crash. So it's important to be careful when you're buying, just because you don't want to buy high and then sell low. But it's difficult to time the market, and you're going to go insane if you try to crunch the numbers. So I say give it a little bit of time, watch it for a week or two, see where the highs are, see where the lows are, watch the news, and if you think it's okay, throw some money in. And there's always such thing called cost averaging, which is where, if we go back over here, cost averaging is where you just get the average cost down. So right now, one share of SPYT is 2004, and my average cost is 2032. That's why my total return is down a little bit, because of course I bought and then it dipped naturally. One important thing to take note of about dividend stocks is that after they pay out their dividends each month or quarter, the stock usually tends to decrease as some people might cash out and take those dividends. But usually after a few days or a week, the stock will slowly go back up to those previous levels, as the whole goal is for people to reinvest those dividends back into the stock, which increases the overall share price. So if you have a little bit of extra cash, I say you might as well throw it in the SPYT. It's great for dividends, but it's not really going to grow that much. It's probably just going to stay around the $20. This is still a very new stock, and so no one can really say if it's going to hit that 20% at the end of the year. However, it still is a great dividend payout, and it's safe. It'll be really interesting to see if the S&P 500 halves in price because of a recession. Will this stock halve in price and go from $20 to $10? If you are a younger investor, and you want to have some growth in your stock, I would not recommend SPYT. It'll most likely just stay around the $20 mark and just pay out some great dividends. So for me, I would say with my portfolio, I would keep it around 20% just so you can collect those dividends or use that as your options buying power. So that way you can mess around and try to get some more money with a little bit more risk involved, but you're not using your own money, it's strictly dividend money. So for me, I might put a few more hundred in there just to let it sit, have auto reinvest, and have that grow. Going back to SPYT, there's a great website by the founders, which I will link down below, and it gives a great, it gives a little overview of what their goal is, what their targets are, how they're doing it, who this is for. But one of the really cool things that they have is it actually shows their holdings, and it shows which credit spreads that they are doing. So I mentioned before they're bullish on SPY, so they think the market's going to go up, and so they're doing call credit spreads on SPY. So you can see right here, here's a call S&P. The expiration is the July 24th, and then this is the strike price on the S&P 500 that they're doing. And then, so I just like the transparency involved. You're able to do the exact contracts that they're doing. You're able to see which contracts they're doing and all of their holdings. So this is it right here. This is everything that they're holding within this ETF. So as each month goes by and they have to make new contracts, sometimes it's cool just to check it out and see how they're doing, see what their options are doing, what they look like, and how this ETF pays out their shareholders. The next stock I'm going to be talking about is an ETF called Vanguard S&P 500, which is just Vanguard's take on the total market. The ticker symbol for this is VOO. As you can see, VOO sits right around $500 right now, and over the total max timeline is almost at 400% growth, which actually beats the normal S&P 500, which only has about 300%. So if you put in all your money at the start of each stock, you would have made more with Vanguard ETF. And the cool thing about this one is it also pays a little bit of dividend. I don't have any shares, unfortunately, just because of how expensive it is. But as you can see, it has all the big names, of course, mostly tech. So there is great opportunity for growth. And right there, it is $1.1 trillion into this ETF, which is insane. VOO is probably going to be the safest bet on this list. It's a total overall market, plus it pays out a great dividend, and you actually will earn more when you put money into this one versus the SPY. So who is this mainly for? VOO is mainly for people who have a longer time horizon. When you're looking at 30, 20, even 40 years into your future of putting money in here. This is not going to be one that you want to buy a lot of when you're about to retire. I believe the dividend is only like 1.5% or something like that. But if it's meant for you to have a large sum of money in there, and it's mainly for growth over that dividend payment. However, it's a really safe option. It's really great. Again, the only downside, similar to SPYT, is that the market is at an all-time high right now. With so much uncertainties about recession or a stock market crash, it may not be the best time to buy. So what I would just recommend for this one is try and find a week that the stock will dip and then throw some money. Maybe do fractional shares where you just throw 20 bucks in there. I probably am going to start throwing in money here just for like a nice safe option where I get a little bit of premium, a little bit of that dividend payout without worrying about too much volatility where I end up losing all my money. The stock I am going to be talking about next is actually an ETF. It's called SCHD, which is very, very popular if you're doing research about dividends. The reason for this popularity is totally justified as well. As you can see right now, it's sitting around $77 and also has a great 200% growth. A lot of the times, dividends don't really have a lot of growth. Dividend stocks don't. If you're heading back to SPYT, which to be fair, it just started, there's no growth whatsoever. It's strictly staying around the $20 mark. And you're just receiving that dividend. So there's no growth in there. It's strictly just that dividend. VOO, on the other hand, it's mainly for growth. It focuses more on growth and is more of a long-term play than to receive dividends for income. But SCHD is a great in-between with a phenomenal dividend payout and also some pretty good growth. If you check it out right here, just do a quick little Google search. It's around 3.6% and $2.83 per share that you own. This is one that I'm probably going to start throwing a lot more money in. Me personally, with my portfolio, I'm going to do probably mainly SCHD and SPYT just because they're nice, safe, and great for that option and great for that premium income. You can see from right here of what sectors it holds, mainly finance, healthcare. Nothing. Notice how the technology is a lot lower. So this may hinder your growth. However, whenever the stock is not doing so well or the market's not doing so well, you're not going to be as hurt as you would if you put more money into SPYT, for example, which holds a lot more technology. Unfortunately, I do not have any money in there right now, so I'm not able to give you a nice example of how much it pays out. However, you can see its holdings. Right here, you got the 52-week low and the 52-week high. So as you can see, it bounces between those two, and overall, trending upwards, just like the market. So if the overall market's going down, this one might go down as well, but it's not going to be as much, so it's not going to hurt your portfolio. And if anything else, just remember when I talked about earlier about the dollar cost averaging. Going to SPY-T, right now it's at 20.04 and my average price is 20.32. So my average price is actually above the current price, which is why my total return is a little bit less. So all I have to do is I'm just going to wait for the dividends to pay out. Wait for my dividends to be paid out right here. And then the stock might go down maybe 50 cents, 30 cents. And then I'm just going to throw a little bit more money in to get that cost average down. So no matter what your goals are, long-term or short-term, you can always do the dollar cost average. If you are investing in a good stock, usually it will recover and even excel where it was before. So where should you put your money? Well, to answer that question, I've got to ask you, what are your goals and what are your timelines? If you're young like me, 19-year-old, fairly new to the stock market, I like the idea of dividends, I like the idea of growth stocks, I would recommend VOO. It's going to be a nice, stable market that is backed by many, many people. It's an ETF. You cover a large portion of different sectors within the market. So it's fairly diversified in that aspect. However, it is $506 for one share currently. So that might be a little bit too much. If that's the case, then I would recommend just doing fractional shares. Put whatever you can into that each month, each week, whatever works best for your lifestyle. So that would be the highest growth. If you're looking for growth, that's going to be the highest growth. The next thing I would recommend is a nice middle. You get a nice little dividend payout, and you also get a nice growth within the share price. And that is SCHD, sitting at around $77. It has some great dividend returns. Many people recommend it, and it's great for starting your dividend portfolio. If you go on Reddit or anywhere online where they recommend dividend portfolios, most of the time SCHD is going to be recommended. It's going to be in there, and that's because of its history. That's because of the growth and the dividend payout. It's awesome. So it's a nice little middle. If you're looking for a little bit of retirement income, it has a little bit of that and a little bit of growth. Nice middle ground. And then if you want to go on the far side and just get some nice income where there's not any growth whatsoever, I'm going to go with SPY-T. It's going to be around $20. Maybe just buy 100 shares to start off. It's around $2,000. So save up, do that. And if you're doing the math with SPY-T, you end up buying those 100 shares and it stays consistent at that 20%. Or let's say that's 16%. So actually here in practice with my $300, I got about 16% back if it stays consistent throughout the year. So if we do the math, $2,000, 16% of that is around $320 at the end of the year, which to me, I think that's pretty good. That's a very nice return, very nice and safe. Finding the right option for you can be difficult at times, but really, it's okay to take your time. You don't have to jump into a position immediately, and it's okay to make mistakes. If you are playing the long run, usually over time the market goes up, so that's always a good thing to go off of. Buy now, sell later. Whether you're looking to generate income as a retired individual, or you like that healthy middle ground where you get a little bit of growth alongside a nice little dividend, or you're just looking for straight growth with a nice complementary dividend, there's always going to be options out there for you. And always remember, you will never lose money taking a profit. I know we always chase the higher and higher profits, which usually that only applies to options, but that still can apply here. If there is a stock that you're looking at or ETF that you really like or has a crazy high dividend yield, like QYLD for example, let's take a look at it. So QYLD does the same thing. It does covered calls against the Nasdaq, but let's take a look at the overall history, the max history on the chart. As you can see, it's not that high, but the main aim, look at that, 52% technology, which technology is a lot more volatile. There's a lot more money to be made, but you can also lose a lot more as well. But the reason people like this stock is because of the dividend yield. Take a look at that. We got almost 12%. So you get $2 per share at the end of the year. And with it only being $17 per share, that's a lot. That is a lot of money being paid in dividends. However, in my personal opinion, QYLD is a dividend trap, which all that means is it has such a crazy high yield to where everyone's throwing money in it because they want to get that $2 a share for a very low cost. However, if you look at the price of the stock, it's decreasing almost 30% over the max course of history. So if you put in money right here, it loses 30%. Now maybe those dividends at such a high yield might get you break even. So let's say you buy in over here at $25 and now it's at $17. Maybe those dividend payouts might make it break even to where you didn't lose almost half your position. But to me, it's just not worth it, and it's way too high of a yield. Another important thing to note is that there's not just these 3 or 4 ETFs or stocks out there. There's plenty other stocks that can cater to your needs, whether that's short-term, long-term. All you got to do is do the research. Another thing to note is that I am not a hedge fund manager. I am not a financial advisor. Please don't base your trades based off what I'm saying and base your buys off of what I'm saying. I'm simply trying to share my knowledge and everything I know. But make your own judgment. If you want to make a paper account, trade it for a few months, buy a few shares. There's a great website that I'll link down below that you can do this on. And it's called Investopedia. I mentioned it before in a previous video. Here, I'll show it now. I don't even know what I put in here, to be honest. Let's see. I had bought a lot of Palantir, and then I bought the QYLD on this one just because I wanted to see how it would perform. And over the course of letting this thing sit for, let me see, I don't know if I can see how long. Well, I've had this for a few months now, and over the course of a few months, it's only been up $2. So if that tells you anything, it's exactly at break even. So it really depends. If you need the dividends for income, if you're retired, maybe this is the way to go. But you're not going to make any money with growth. So it's something to think about. If you enjoyed the video and want to see more like it, please leave a comment and like down below to let me know. And make sure you follow me on Instagram and TikTok. And with that being said, I hope you enjoyed, and I'll see you in the next one.